Value, this is the other question everyone always says, well, how do I value my business? Well, like beauty, value is in the eye of the beholder. So the investor is the best determinant of the value of your business, not you. If they're telling you your business is worth so little that their investment is going to mean they get a large majority chunk, then they should be prepared and you should be prepared to let them execute the business. I never want to be a large majority owner of the business I invest in. I want to be a large minority owner because I expect the business to grow and I expect to get diluted by later rounds of investing.
Where would you define this in percentage? What?
I normally want to be somewhere between 20 and 40%. Okay? Most businesses I invest in are pre-revenue, therefore by any definition have zero value. Discounted cash flow is a wonderful data point, but it is not the value of the business. Okay? And we'll talk about exits in just a moment because exits is really where the value is. So there are two types of business. There's a lifestyle business. That's a business that does just that. It generates a really nice lifestyle. There are lots of businesses like that. Most of the shops you see in the street that have been there for 20 years are lifestyle businesses. They bring in, say, $2 million a year. The person who owns the shop probably works there. Maybe after a number of years they've accumulated enough that they hire a manager, so they don't have to work there every day. But they can make a really nice living out of that. They live in a nice house, they drive a nice car, the kids go to nice schools, they don't have huge debts, at least not after the first 5 or 10 years of running the business. They've paid off their mortgages. They're great businesses. They're just not very, very good for investors. There's no way for an investor to get money out of it. They can wait for a 30-year chain of dividends that might actually give them a return. They can do a hell of a lot better putting their money in the bank. Far less risky and they'll get a better return faster. So lifestyle businesses are great, but they're not for investors. And so the key point there is, from an investor's point of view, the capital is captive. They're never going to be able to get their money out. This is the problem with retail businesses. Interesting phenomenon that most of the online businesses today that are being developed are retail businesses. So the model has changed. It used to be that you didn't invest in retail businesses because they were capital intensive, labour intensive, slow to grow in value, and hard to sell. But now there are these people who are selling shoes online, eyeglasses online, dresses online, etc. They don't need a lot of capital, they don't need a lot of labour, they can grow very quickly and they can be sold. So retail is suddenly open to early stage investing, but most early stage investors are not retail people. So it's a very challenging space from the investor's point of view. A growth business, a high growth business, and this here the key thing is this statement down here. Strategic value, right? This has financial value. In other words, when you sell that Main Street business, it sells for 3 or 4 times the last 3 years' average net profit. In other words, the acquirer is buying from you the next 3 years' profit on the assumption probably that they can somehow do a little bit better and make a payback on the acquisition price in 2 years. It's not a very exciting outcome unless you've spent 15 years making that profit. Huge! And that's what happens in the ordinary M&A sector. When one established business buys another established business, they use that same basic formula. The only reason that it's a $500 million acquisition is because they've spent 20 years making that profit to be $100 million and they're getting 5 times. Okay? Strategic value is where the early stage world, the venture capital world, everything really, really turns. That's when an acquirer can exploit what you've got orders of magnitude greater than you can, faster than you can, faster probably than you, more than you probably ever could. That's why you might buy an Instagram for $1 billion. Because if you're Facebook and you get 1 million users on Instagram and you have a distribution channel, maybe you can actually make money out of that and Instagram still can't. I don't believe that was the case in that particular example, but strategic value often works if you think about it in a specific piece of technology rather than a general business. So someone who creates a really smart piece of software or hardware but never really manages to convince the market to buy it. Let's say it's something that makes a digital camera really, really good. They sell that to Samsung or Fuji. They put it in their camera, in their distribution chain, with their brand support, and suddenly they've got the next smash hit camera on the market. They're making $100 million a year profit off that 12 months after they bought the company. And the company who sold it to them wouldn't make $100 million profit 12 years after that. That's what strategic value is about. That excites investors. If you can identify strategic value in your business, what it will be and who will value it, and pay a high premium for it. Because they don't pay your history, they pay you a piece of their future. Right? They pay a premium based on what it will be worth to them. Oh, I can get $100 million profit in 12 months. I'll pay you $40 million for that right now. Because I'm going to make it back in 12 months. That's not a big deal. That's strategic value. So as I've been saying, if you're going to approach the investment process, be prepared, do these things. You know, have a plan, know what skills you have and what you don't have, know what to expect, know when to walk away. Like I said, if it's not the right investor for you, don't do the deal. Walk away. You're not trapped. It's always your decision. And know yourself is the bottom line that's really good. These are some classic tips on how to be successful. The first one is, of course, something you've probably heard a lot, be disruptive. What does disruptive mean? Well, it means lots of different things to lots of different people. But fundamentally, if you're going to change the shape of the market in some way and create opportunity that nobody else is currently accessing, then you're being disruptive, and you could, in one sense, argue you have no direct competition. But be very clear. Number one, you're never unique. And number two, you always have competition. Because your customers are not sitting around with a little pile of money that said, this is Fred's money. I'm going to wait till Fred comes with his business, and then I'm going to spend this money. They're spending every cent they're going to spend today, right now, on something. So you always have competition for the spend that your customer has, even if it isn't an identical product. So if you go to your porter, it may not be a competitor, but it may be a substitute. But it's always there. Okay? And I think that brings us to Q&A. Oh, that's our process. Read that on our website. So,
John,